We have hit the noon hour in the Eastern Time Zone, 11 Central, and of course that means we're about to bring in tech trader Sean Udell. And before I get rolling with him, I'm going to share a story with the listeners here. I received a text message earlier this morning, and the text message was from somebody in my phone named Sean, and it said, "The next major move is higher. I'm no longer interested in hating Fang." And I texted him back and thought that somebody must have hacked your account. And sure enough, it was actually Sean Udell who texted me that message. So I had to bring him on so he could explain himself. So with that said, good morning, Sean.
Morning, and it's 10:02 here in Mountain Time, and I must say I love being back in the Mountain Time zone for 6 months. It's just life changing for me. But yeah, so I put a note out. I'm not going to reiterate the note exactly because the one thing I didn't really talk about much in the note is why. You probably want to ask me why.
I
just kind of put my stance out. I just put my stance out, but the short of it is, hey, who's been probably the most vocal, most aggressive, on your platform on basically Fang hatred, Cloud Bubble hatred, NVIDIA hatred, etc. I frankly should have shorted more of the stuff, but hey, what I shorted has worked pretty well. And I wasn't in any of those names, so I avoided all the downside from all those names. And again, maybe some other guys kind of had equal hatred to me on these names, but at this point, you're not a good, let alone a great trader if you just stick to an opinion and never change it when the facts change, right? Mm-hmm. So, hey, should I stay short or should I keep saying that NVIDIA is a short after it's dropped more than 50%? I don't think it's prudent. Now, I do think NVIDIA will ultimately go down to roughly $80, maybe even lower, because this whole move started from 40. NVIDIA was a very undervalued company in the 25 to 30 range. I was long, liked the stock a lot back in 2012, 2013. In fact, this is one of the names I scrubbed because it was so boring. It lacked any positive mojo. I ended up basically scrubbing this name, and it went into one of three names, those three names being either Facebook, Apple, or Skyworks back in 2013. So, NVIDIA's a name I know very, very well. It was actually a frustrating long for the ardent longs. And frankly, I made a lot more money on Facebook in 18 months than, it would have taken me a lot longer. It would have taken me a long time to triple my money on NVIDIA from that 2013, 2012 hold. So, but what happened? They basically, everything that could go right for them did, which is very unusual, by the way. It's very unusual to hit at every single component of your business you can at the same time. But hey, the stock is down 50% from highs, even though I think it basically could drop another 50%. I think the big money, the easy move pretty much has been made. Now, NVIDIA was also a very large component of the stocks. Okay, let's circle to Facebook. Same thing. I don't know if anybody else was pounding the table saying Facebook is a ludicrous buy at 220 or 200 or even 190. Okay, I was. Well, guess what? What did I always kind of say? Hey, 125, 135. I might even be long the name. The problem is I don't really want to be long Facebook because yesterday's leaders are usually not. They don't reassert themselves as the next leadership group. And usually what happens to the former market leaders, which I believe NVIDIA and Facebook and Amazon and Fang are former market leaders now, they sometimes die a slow, painful death, meaning they try to kind of get bought and they try to resurge themselves a few times. But look at Microsoft, look at Cisco, look at Amazon years and years and years ago. These guys were former leaders. It took them anywhere from a decade to 15 years to become good stocks again or good trading vehicles again. So anyway, I'll get to the exact reasoning, but this is all kind of embroiled in the reasoning. Sometimes, hey, you get a big enough move, you got to kind of say, hey, the move is made, I got to move on now. So that's part of it. But the other thing I just think structurally, fundamentally, again, we don't have things like an uptick rule anymore. The indices are heavily skewed and heavily weighted to a small number of stocks. But the way the indices are constructed, I actually kind of feel, and I've said this before, that this could be a lot like 1998. What I mean by that is the big correction that we had in 1998 before we had a huge move higher. I've said that before. I kind of think this is that move. The only difference is in 98, the NASDAQ corrected something like 25 to 28%. Well, frankly, it was easier for the NASDAQ to correct like that back then because it was the fact that there were fewer stocks that represented such a large percent of the index. So in other words, back then, if you had 200 or 300 or 400 stocks drop 40, 50, 60%, like what's just happened, the index would drop more. Well, nowadays, it's like such a huge weight to a small number of stocks that are pretty sticky to the upside, like Apple and like Microsoft in particular. Yeah, it's pretty hard to get Apple to drop 25 or 35 or 50%, right? It's pretty hard to get Microsoft to drop 40+%. We did just see Facebook drop 40%, but that's like one of the very few small number of large cap stocks. So the bottom line is the average stock has taken a huge amount of pain. You know, the average stock has a beta which is higher than the market. So that's the other thing I look at. I don't just look at the FANG names, I look at kind of everything else. And so when I see that the average stock has dropped, 2, 3, 4x what the indices have dropped, in my mind, we've actually put in a much bigger correction. So in other words, the necessary amount, I've been saying for a long time, months now, after my first 2 right correction calls this year, I've kind of been waiting for the big number 3. Well, we finally had it. And while we're not down 15, 20% on the indices, I think we're down enough, and enough names are down enough that it basically kind of fulfills my requirement of sort of that major correction that I was looking for. So like I say, I don't want to be a pig. I don't want to overstay my welcome on the short side. I don't want to overstay my welcome and tell people that, yeah, these stocks are going way lower when I don't know if they really are anymore. The only 2 dangerous FANG stocks that I kind of still see, I still think Amazon might have quite a bit of downside, and I still think Netflix might have quite a bit of downside. But even Netflix, I mean, I don't know, it's probably approaching 40% off sale. I wouldn't buy any. But anyway, I think that's it. I mean, the other thing, now that nobody thinks we can have, I mean, I don't think there's a person on the planet that thinks we're going to have a year-end rally. Well, now maybe we might. Sentiment also got very low. That's another necessary precursor. And something that everybody used to talk about, which nobody does anymore, valuations. Valuations have just been cut huge. So, especially on a relative basis, so if you think that, or if you know that earnings and revenues have grown, whatever it is, each respective name, and some names it's 30%, some names it's 40, some names it's 5, but let's just use a raw net. When you get 20% earnings growth and a stock declines 20%, what happens? You actually have a 40% cheaper stock on valuation. It's not 20% cheaper, it's 40%. So because you got the earnings growth, plus you got the correction, so you kind of have to, it's a cumulative valuation correction. So in other words, the valuation correction has actually been greater than the percentage downside in a lot of these stocks as well. So I add it all up. I think the next major move is higher. I don't know how much higher. I usually more focus on, let's get the direction right. If you get the direction right, everything else kind of falls into place. So whether we go up 8% or 10% or 15% or 20%, I don't really know. But again, we might kind of overshoot. So if this 1998 analog is correct, we probably have a bigger upside move maybe than even I think we're going to. But yeah, that's basically it. I think major move now is up. I think we put enough pain. Tons of stocks are down a lot. We could talk specific names, whether it's justified or not, but they are where they are. And again, there's a lot of companies down huge that haven't had any issues. They haven't missed a quarter. They haven't even really lowered growth expectations very much. Now maybe some of that's going to come a little bit, but I don't know. I still think for most of my names I have, as you know, a pretty strong fundamental view and a fundamental backdrop. I think most of the stuff I like are going to produce pretty superior growth to fundamental growth to the indices. So I haven't really changed the view really on hardly any names, I mean, frankly. So the only new names I'm going to be putting a post out and some work, doing some work on is this whole group of newer IPOs. So things like Pivotal, I mentioned a little bit today, things like Pivotal, things like DocuSign. By the way, I've never liked DocuSign until the last 2 days, pretty much since it was a public company. I like it now. Never really liked Forescout Technologies much, literally until last 2 days. What's another one? Well, I owned some ZUO before, but I never really was like that committed to it. You know, I've added to it last 2 days. So these are all these newer IPOs, even Zscaler, by the way. So I never thought I'd get a crack at Zscaler again. I knew it would come down a lot at some point, but I didn't think it would happen this quickly. I don't know. I'm not a buyer of Zscaler here at 32, but it's at least a lot less nosebleed at 32 than it was at 48. So, you know, they're kind of in that 50, 55, 60% revenue growth count. So they're one of the more hyper growth names. Anyway, this whole new crop of the newer IPOs. Again, Pivotal's probably, if I had to pick a favorite, it's probably my favorite one in there. Anyway, long story short, I think, you know, when everybody else is running from beta, when everybody else, I mean, Goldman Sachs came out and they said, it's time to get defensive, it's time to raise cash. Okay, well, they might be right, but where were they 4 months ago? Where were they this spring? I mean, that call would have been a great call before the market corrected huge, and FANG dropped. The average FANG stock is down 35%. So, you know, to me, when you get the kind of declines we're seeing, you know, I'm going to move out on the risk curve, not in. I'm gonna look for beta. I'm not going to shy away from it. You know, I'm not going to buy utilities. I'm going to buy the stuff I like that maybe even has a little more risk and more upside. That's how I play it.
All right, before we dive into some of the more specific names, I want to just get your overall thought on the indices, and I guess we'll stick with the NASDAQ in particular since that's your bread and butter. Lay out what you see as a base case scenario as far as if we have hit a key inflection point and we are now in the midst of a greater move higher. What's the base case scenario, and then what's the best case scenario? And if you could, just kind of lay out...
like total upside or something? Total upside?
Yeah, and I'm not saying, you know, hypothetically, yeah, we could go up 40% just because we theoretically could. But
I mean, this is a pretty easy call. You know, I think you just do a measured move, right? So basically, okay, so, you know, we've had a measured move down of it. I mean, we put in a 10% correction plus. What is it? As of the low today, maybe it was like 13, 14% or something. So now technically, you're going to have some guys that won't even like the NASDAQ again, okay? They won't even like it until it goes to like 7,700. That's when a lot of like momentum guys will go, oh, hey, it's now safe to put your toe back in the water. Well, that's 10% higher from here. So I would say that's kind of minimum. Minimum, I think NASDAQ goes to 7,700, basically. That's 1,100 points. I mean, that's nothing to sneeze at. So the key is that means I'm going to have certain names that are going to go up 3x that or more. But yeah, I think 7,700. And by the way, if I put a time frame on it, I'd say by the end of Q1. Because the one thing I did stress too is that we're going to have a lot of chop. We're going to have a lot of fits and starts. There's still a growth there. At a minimum, we do have a growth scare. By the way, I mean, I do think we have a growth scare. There's definitely evidence that people don't know, hey, oil's coming down. Some of these growth numbers are not looking good. Housing starts have declined a lot. You know, I know all these numbers. I know all these numbers as well as anybody. But there's a difference between things that crimp growth in the short term and things that change sort of the secular nature or the cyclical nature of a global sort of rebound. I actually think we're actually more in the early stages of a global rebound economically. So, and that's a much longer, broader discussion, not for today. But yeah, I think technically measured move, pretty easy call, 10%. By the way, I do like the formation. So what we have from technically in the NASDAQ, we have a perfectly failed inverse head and shoulders pattern. And why did the inverse head and shoulders pattern fail? I think it's because CNBC identified it. I'm literally not kidding. I think we probably had a good chance of this inverse head and shoulders pattern working, but CNBC actually spotted it. So you know, if it's spottable by the everyday media, nothing against those guys. Hey, kudos to them for spotting it. But those aren't the guys that are going to spot something like that sticks. It just doesn't work that way, right? If the Drudge report says, "Oh my God, I'm selling stocks are going down," that's your contrary signal to buy stocks, right? Same kind of effect. So the bottom line is, what we now have is now have a double bottom. So we have a double bottom from the October lows, which I think is a far stickier chance of holding anyway. And heck, I mean, we're not very far from the April or even February lows at this point. I mean, we're within an hour of the February lows if we kept going like we were. So, and I don't necessarily need to, we don't have to go hit the February lows, but we could, right? And by the way, when I say a major move, I'm saying a major move. I'm not talking the next 2%. So, I mean, we could go 2 or 3 or 4% lower before this ultimately fulfills. I don't know if we really will, though. I mean, this action today feels kind of sticky, meaning the low today it kind of feels like it might stick to me. But yeah, I think a 10% move plus, and that's probably minimum. 10% move by the end of Q1 is probably my base case. Best case, honestly, don't know. You get a China trade deal, that might be worth 8 to 9 to 12% to the NASDAQ itself. If you have a Fed that cools their jets, I don't know, is that another 5%? If you don't have a big decline in fundamental revenue and earnings growth, I don't know, is that another 15% next year? So, I mean, again, everybody thought that correction in 1998 was Armageddon. It really scared the Fed. The Fed almost kind of reversed course. They actually added liquidity we didn't need. Also, the global problems they kind of were worried about weren't really global problems. It was sort of just a market liquidity scare. And corporate earnings were set to improve or keep going on the path they were at the time. Again, this condition kind of we're in right now kind of feels the same to me. So, if we don't have a big decline in sort of tech earnings, tech revenue growth, stocks are actually super cheap again. I'm not so sure next year is going to be as good as this year. But, we haven't really seen. I mean, the one thing I was probably surprised about this quarter is still just the shockingly large number of great reports we had this quarter. I mean, I'm having a hard time even remembering companies that missed or guided lower. I mean, the obvious names, which things I said I was worried about. Facebook I was worried about. NVIDIA I was worried about. In fact, NVIDIA my call on it was not quite as clean as AOI. I was crystal clear on calling peak earnings on AOI. I kind of pussyfooted around the call on NVIDIA, but I pretty much said that for the last 2, 3, 4 quarters. I said, look, you got peak earnings. This is a semiconductor company. It's not a software company. And it eventually caught up with them. But yeah, no, I mean, I don't really know best case. I don't really do a best case. I kind of just say, let's just take what the market gives us. And I tend to kind of call tops when I see them. I mean, I was pretty close to the last top, I don't know, within at least a few hundred points of it. I thought we were going to top out kind of 78, 7,900. We went to 8,100. I think around between 7,850 and 7,900 is, I think, when I said, look, the NASDAQ needs to drop 900 points again. So I missed that by 200-300 points and by probably a couple months. But yeah, I think base case 7,700 NASDAQ, and there's plenty of reasons for it. Again, could be quite a bit better. I mean, it depends how many pieces of good news sort of get reinserted into the mix, and that's what we don't know. There's no way to know that until they get reinserted.
All right, so if we have hit that inflection point, are you interested or looking to cover the IGV position?
No, I'm probably going to, there's certain names I'm probably going to stay short, IGV and Adobe and Microsoft, probably until something happens to where I dramatically reduce my net tech exposure. So from a tactical standpoint, from a tactical standpoint, the only short I still really, really like is Microsoft. So that, like I was gung-ho about my other shorts before. As you know, I covered my new Relic short. I covered the Verona short weeks earlier than that. But yeah, probably the only short I'm like excited about that I think has a lot of downside that nobody expects would be something like Microsoft. IGV though, I mean, even Kramer was saying, like, he finally kind of spotted what I've been fighting. You know, something like an Adobe just hasn't dropped very much. So for as big as that gain, the ultimate gain, I mean, we're talking about, again, 2013. I liked Adobe. It was a $30 stock. I liked Avago in 2013. It was a $30 stock. But, you know, Adobe went from 30 to 270. I mean, that's a huge move. Even if it's a multi-year move, it's a huge move. Adobe's not really cheap until you kind of cut it in half. So from here, I mean, so, and you know, what happens is when these major moves really break, and this cloud move is a major move, when they break, they tend to kind of, they don't just go to where they should go, they kind of overshoot. So, you know, we'll see. You know, Adobe is not even close to an overshoot. But yeah, so like Adobe, IGV is still full of stuff like Adobe. Like the whole top 10, there's the only name in the top 10 of IGV which is reasonably valued is Oracle, and I don't really like Oracle very much either. I don't think I would short it here. But there's literally 80 names I'd rather be long than Oracle. So I'm not too worried that Oracle likes it. Well, that's fine. I mean, it's, you know, hey, Warren Buffett liked Apple a lot at 200, and that's not doing that great anymore. And I think Apple's got more downside. By the way, I don't think Warren Buffett's really picking things anymore. He stopped a while. He hired the two guys, Todd something and somebody else something. And hey, they're good money managers. They have to work with the sheer fact that they have so much money to deploy. But hey, even great money managers can buy stocks at the wrong time. So I really do think I think Berkshire has been buying too much Apple at too high prices. By the way, I'd probably rather buy Oracle here than Apple. At least until Apple gets to you know, a lower price. And again, this former largest long of mine multiple times in my life. So I'm at times I've been the biggest bull on the planet on Apple. I'm certainly not one right now. So, you know, we'll see what happens, but I'm not too worried about Berkshire's buying of that. Like I say, there's other stuff, and again, I don't think Oracle's a terrible buy. I just don't. For me personally, there's lots of other stuff I'd rather be in. But you know, maybe an Oracle could kind of become. I think Oracle's got a much better chance of becoming a leader. Because it's more of a value-oriented tech stock than certainly one of the former leaders re-emerging and becoming a leader again. So, you know, I probably like the Oracle buy better than, you know, keep fire away at Apple buys or something like that. Did you have another question though? I may have skirted something. I apologize if I did.
Well, my next question just stems from if we are at that key inflection point and you see the base case scenario of about 10% in the indices, you're looking for some of those stocks that are 3 times. Which are the ones that have the highest probability of having that 3x move that you always look for?
Well, there's a ton of them. I mean, just an obvious. Well, okay, something like a Cloudera, something like a CommScope, something like again a Docu. Docu, I'd probably, I don't know, what would a move to 50-55 be? I don't know, that might be 30%, 30-35%. I still think FireEye is extremely undervalued. That name, though, hasn't really been punished that much. That's not really like one of the victims of this whole sell-off. But certainly ZUO, which I've just been buying, a Redfin. Now, Redfin needs a turn in the real estate market. Again, Redfin is very misunderstood. Redfin's basically been selling off because of real estate, very real issue that real estate is dropping, but they're a market share gainer. I mean, here's a flyer. I mean, this is a name I don't like. Never really liked it, but every single time I've ever bought this name in my life, I've made money. It's because I only buy it in market conditions like this. It's something like Zillow, ZG. I mean, this is not a fundamental name I like, but I think there's a very high probability that Zillow goes up and not down more from here. Or I always like to say, hey, a 1 down, 4 up, or a 1 down, 5 up sort of situation. So for every buck you're able to withstand a downside, I think you have $3 to $4 of upside on something like Zillow. So there you go. I mean, if the Zillow were just to go up and fill the gap, you got to move from, you know, 27 to $40, something like that. And this is not, Zillow wasn't an expensive stock at 55, let alone 45. So it's a pretty good valuation play. You just here's what I don't like. Oh, you wanted 5. Okay, TLND is a possible. I don't know if I'm going to buy any of that, but that's a possible. Probably more names like Pivotal, PVTL would be in that mix. Another name, again, had never liked this until last 2-3 days. Spotify. Spotify has gone from 200 to 125. I'm pretty interested in Spotify here. I haven't bought it yet, but I could. So all that kind of stuff. I'll just kind of round up names in that. By the way, I like semiconductors too. So this is completely. I'm going to open up another subject. What's a famous thing that happens at inflection points? There are top ticks and there are bottom ticks. You get analyst upgrades at highs. You get at unsustainable highs. You also get analyst downgrades at unsustainable lows. What got downgraded hugely today? I saw a bunch of downgrades. There were multiple Micron downgrades. There was at least one Skyworks downgrade. There was at least one Western Digital downgrade. I don't think I've said anything loving about Western Digital since I've joined Briefing. I now would say I'm going to start saying loving things about Western Digital here. Western Digital. I think some people forget how good they've been on M&A. Western Digital owns SanDisk. SanDisk was one of my favorite tech stocks, cyclical tech stocks. So anytime we had a cyclical low in tech, I would literally always buy SanDisk. Unfortunately, SanDisk sold to Western Digital, but they're still a big, important part of Western Digital. SanDisk might have one of the better products, actually, for the Christmas season, from a retail standpoint. They're also, a strong player in enterprise. But no, Western Digital I really like. We're probably at 5 names now, and I'd even say Micron. I haven't bought Micron yet, but kind of ever since it kind of got to 38.50 to 40. I've been more interested in, I don't really dislike the name anymore, and vicious downgrades or price target cuts on that. It could go a little lower, but I think if you buy Micron here, and as long as you don't get stopped out on a panic, you give it a couple quarters, I would be hard pressed to believe you don't have a stock that's materially higher within 3 to 6 months.
All right, let's hit some listener questions specific to you. We've got one listener asking, why aren't Microsoft and Adobe on your focus list?
Well, Microsoft might be as a short. They're both kind of IGV plays. So IGV is in it. I probably, it's sort of funny. As the person reading my mind, it's very likely that Microsoft ends up being put on my next focus list as a short. But yeah, the only issue now is I'm going to concentrate more on longs, I think, than shorts now. There's still going to be some good shorts. There's still going to be plenty of things that go down, but yeah, I think the bulk of my work is probably going to be on longs now. At least, hey, if we end up going up too quickly and too sharply, and we get excessive, sentiment gets excessive. By the way, I didn't even mention sentiment. My sentiment work is kind of screaming pretty bullish right now too. But yeah, so if we overshoot, if we go up too quick, sentiment gets too good too quickly, then I might turn table and kind of start looking at some shorts again. But yeah, no, it's possible Microsoft could be on my focus list as the second short name.
All right, and I've got one that I'm sure a lot of listeners might have this question, and so since it was asked, this listener in particular hasn't taken any of your trades because he doesn't understand how you manage risk. Can you elaborate on that?
Yeah, I've talked about that. I don't know if they're a newer briefing sub. My view of risk is different. So everybody kind of tends to think about risk as only a downside equation. But I kind of only believe that there's only one really good way to manage risk, and that's basically to reduce exposure and raise cash. So, but I have paired a lot of my risk. I've done a lot more shorts this year than I did in the prior 2 or 3 years. So I think it's a combination. One, I have shorts that pair off some risk. Two, I just sell stuff and I raise cash. I do believe that pretty much raising cash is pretty much the best defense if you're truly worried about downside. But also, I kind of view risk more of through a cycle. So in other words, if I can take a lot of pain in an individual position because I do think I balance things out pretty well. I tend to have a lot of names. A lot of times I have a lot of names working where I have other names not working. So, but I don't really believe in position-by-position stops. Hey, if they work for other people and other people swear by them, great for them. I actually think position-by-position stops stop you from making money. By the way, that's kind of a Warren Buffett. I'm kind of paraphrasing a Warren Buffett quote there. But I basically believe if I'm going to buy something, I'm going to hold it unless it's a short-term trade, which I don't talk about much on the briefing platform. But unless it's a short-term trade, intraday short-term trades, I do use stop methodologies and things like that. But if I'm recommending on the briefing platform, basically means I'm going to hold it overnight. And if I'm going to hold something overnight, I might hold stuff not just multiple weeks, but multiple quarters. So I tend to view risk as like, what are the odds that I'm going to take a permanent loss in something? Meaning I'm so wrong on a stock, it goes down to a point that it basically is an unrecoverable price move lower. And probably the biggest way I personally control risk is really position management, and the fact that where a lot of people might only buy a position or buy into a position 1 or 2 or 3 times, I might buy into a position 10 times. So there's a lot of times I'm very cautious on buying. I'll buy the same name at least 3 or 4 or 5 times, if not 8 to 10 times. So, I don't mind taking a lot of pain, let's even say up to 50% plus pain on a small initial position. If by the time I get my full position in, my cost basis is pretty good, and I'm kind of positioned at the right point in the cycle. So for example, I took a fair amount of Nutanix pain. Nutanix would be a very good name to think about. I took a fair amount of Nutanix pain with the very smallest part of my initial position. I think I was in that stock kind of low to mid 20s, and at one point it was like $14, $15. But by the time I basically got to a full position, I really wasn't taking hardly any pain because I bought that stock at sufficiently low prices numerous times that just the tiniest little bit, like the first 10, 15% turn off of lows, I was break even or profitable. So I would say smart buying, not getting too aggressive too early. I tend to wait for charts to get pretty pukey looking on the downside before I commit. Things like that. So I don't know. I kind of view risk totally differently. I tend to view it as through a cycle. I tend to view it as what's going to cause me a permanent loss as opposed to just a trading loss. And I definitely believe. Hey, I can sell everything in 5 minutes if I have to. I think I can right click all my positions and sell them all at once in one click. So it's a click close trade. If I wanted to, I would probably get a bunch of bad prices and a bunch of bad fills, but I can do that. So I haven't really felt the need to do that. So I much more believe in a portfolio stop method. If you are going to use stops, it should be portfolio stop versus position by position. Again, that's just me. That works for me. And that's what we talk about. We talk about what we do. We're not financial. Everybody should consult your own financial advisors and the professionals you work with for your own personal risk management strategy, right? We just talk about what we do and how we're managing our own funds. So the bottom line is, but I really do believe it too. I've never heard Warren Buffett once ever talk about a stop on a stock. So if it's good enough for Warren, basically it's good enough for me. I don't know if I've ever heard David Tepper talk about position by position stop strategies. I don't know if I ever heard Peter Lynch talk about position by position stop strategies. I don't think I've ever heard Bill Miller talk about position by position. So it's not that I'm really alone on this. Like say, I don't think Warren Buffett's ever set a stop on any position. So, and I'm not saying I've never set a stop on any position. I definitely do it on trading positions, but I pretty much do the same thing. I mean, if I like a stock, why would I put a stop on it? I mean, to me, it's sort of counterintuitive, especially tech. I think part of it too, not to get too long-winded, but I like to operate in some of the more highly volatile areas of the market. So stops just don't really work. I mean, if I put a 10% stop on everything, I'd pretty much get stopped out of all my best positions before they went 2 or 3 or 4x for me. I would. I'd have been stopped out of Twitter, I'd been stopped out of Nutanix, I would have been stopped out of Apple, I would have been stopped out of Google, I would have been stopped out of Micron. So pretty much everything I can think of that was ever a 2, 3, 4, 5, or even 8, 9, 10x mover, I would have been stopped if I would have had 10% stop. So I think it's just math. You just have to look at the math, so everybody. Here's the most important lesson. Everybody has to find a risk management strategy that works for them. The other thing I'm going to say, and I'm going to stress this, everybody thinks about risk as risk of loss because something goes down. Well, first of all, you don't have a loss till you sell. You don't have a loss unless you're forced to sell. That's more of a leverage issue. A lot of people don't manage leverage very well. I think I manage leverage really well when I do use it. The other thing is that there is a risk of the biggest risk, in my view, is not maximizing returns when returns are good. Frankly, I've done a poor job of that. The biggest sin, the biggest mistake I've made is being on names that I sold too early. I sold Twilio too early. Nutanix was pretty darn good, especially for how low I was buying it. But I sold Nutanix early. I sold probably my biggest mistake in the last few years was, and even though I pretty much tripled my money on Facebook, I sold Facebook way too early. I was basically out of Facebook at $75. So I left a lot of points on the table. So to me, that's risk. So there's a huge amount of risk in fact, so this goes to the single biggest mistake I see people do. People do backwards trading. So they're worried about taking a 7% loss, and yet, so let's say you get an initial move. Let's say they make a great trade. They buy a stock at a good price. Let's say they buy DocU at 38. Let's say in 3 days DocU's at 40 or 41. Okay, and they sell it. They take a 3-point gain on DocU, not even a 10% gain. What if DocU in 4 quarters is 70, 80, 90 bucks, right? So if you don't make the money, in other words, if you're going to take the risk of stock ownership, I think you kind of need to position yourself to stay in stuff long enough to get paid off. So to me, one of the biggest risks is not being good at managing your winners and not managing your gains or staying in stuff long enough to produce good gains. Because honestly, the thing that helps heal your wounds against losers is huge winners. I mean, you triple up on Twitter, that gives you a lot of cushion. And I tripled up on my Twitter position. So, I think that's the best way to say it. If you start producing big winners and sufficient gains, and by the way, we all have lots of mistakes. We all have lots of losers. We all have to eat it on a number of trades, number of investments. But if you can produce a few big key winners, that's a huge risk mitigator right there. So I think that's really the best way to say it. Again, Warren Buffett doesn't use position-by-position stops. I don't. I don't think David Tepper does. I don't think Bill Miller ever did. I don't think Peter Lynch ever did. So if those guys don't need to use position-to-position stops, I certainly don't.
I think an important distinction to make for any of the listeners out there, anybody who is associated with Briefing Trader, is you really have to understand the time frames in which each trader is putting on their positions. When you look at TechTrader,
couldn't agree more. Not to interrupt you, but that is, if there's a single biggest thing that you are saying, that I agree with a ton of the stuff you're saying, but you're 100% right. So keep going on.
Yeah, so it's a different ball game. You have to really think of who you're taking the actual ideas from. If you're looking at TechTrader, if I was taking everybody's trades or trying to manage whose style fits mine, or how do I fit it into my own book. I would take tech traders trades in a strictly portfolio sense, so that I'm not trading tech traders trades. I'm using them as an investment portfolio that I'm willing to hold on to for however long it may be. In many times, it's several quarters. We're talking about trades that you made 3-4 quarters ago when we first started, and you haven't gotten out of things like Twitter, maybe taken some profits, but you've held that position for a long time. You've come on here for over a year now and talked about Twitter, how you liked it, where you liked it, and all that, and that's just one of many names in particular. Qualcomm, another one. So you really have to understand whose trade you're taking and why a stop order in blue chip traders' names is a lot different than having no stop from tech trader. So that, if there's nothing else that you can take away from a risk standpoint when you're listening to tech trader here, it's definitely that you really have to take into account the time frame, and that it's not a quote unquote trade that's going to be taken off if he gets a $3 move in the name, where scalp trader or blue chip trader may take some profit in those names. So I think that's a very important thing to take away from this discussion, especially as it relates to Sean. So
Oh yeah, and by the way, if I was trading futures, for example, there's no way I would trade futures the same way I trade Twitter. Okay, futures. You could put a fundamental case on a futures trade. I suppose you can trade futures long term, but I think the whole point of trading futures is it's a short term, hyper liquid trading vehicle, right? So I think if you're trading futures, you by definition just have a whole totally different type of trading methodology. The other thing I would say that I kind of forgot about is that I think I said this many moons ago, and I've written. Maybe I'll try to find a write-up again. But generally, if I'm buying something, I'm willing to hold it through an earnings report. There are some traders out there who literally their method is they sell all their positions before earnings because they don't want to take the earnings risk. Well, my view is, hey, the big payoffs tend to come on the big catalyst. Earnings are the big catalyst, so therefore, here's my, if I don't like something enough to hold it through an earnings report, guess what? I just don't own it. So that's a huge. Here's the other thing. Who else said FANG was dangerous? Who else said NVIDIA was dangerous? Who else was warning about the declines and these sort of things? That's a lot of risk mitigation. Some people are just better at kind of knowing what to avoid, right? Some people are. Some people are good at kind of just not getting hit by the most popular things. Right now, what's everybody talking about? Like how bad the SOX is, how much danger there are in semiconductor. You know what? I like the SOX. I like the SOX a hell of a lot more now than I did a few months ago. There's a lot of semiconductor names I think are pretty attractive values again. So, again, I was not telling people to buy. I was warning about the dangers. In fact, I was short Micron at one point. So that's a lot of, not to overstate it, but if you're kind of good at avoiding the most dangerous things at the most dangerous times, that's one of the most important risk mitigation strategies you can have. Is not feeling like you need to be in the popular hype name at all-time highs when it carries massive amount of risk. That's one of the best ways I avoid risk. I just avoid popular manias. In fact, a lot of times I'm shorting them. So anyway, but yeah, position management, cash, risk management, it has to be a standalone decision of everybody's own responsibility. But yeah, the time, the duration that somebody's willing to hold something is paramount. You have to know whoever you're reading. You have to know what's the time frame on their trades. Absolutely. I'm probably, I don't know. You correct me if I'm wrong. I'm probably the longest holder on the platform. Maybe I'm not. Maybe there are a couple guys, but you tell me. I don't know. But because I don't read everything that everybody writes. I read a lot of the stuff, but I don't read everything. But I'm probably the person that holds positions the longest, would be my guess.
Among the active traders, the active post, I would say yes. So if you're just going to group, we have a couple others who are even longer, I would say.
Okay.
But I've never
By
timed.
the way,
I've never timed it out.
Here's a last thought. Okay, something like CommScope. Never mentioned anything positive about CommScope at all till just recently. Okay, so a stock, again, this is just math. I mean, I think a lot of people misinterpret this because the popular media, a lot of the people selling services out there, I call them charlatans because they're broken clock traders. Now, I'm not talking about people on briefing, I'm talking about people on competing platforms or that sell these snake oil services, these technical trading services that are just horrendously bad. Like they recommend 100 things, I doubt 15 calls are even right. It's like, look, mathematically you should be right 50% of the time because you got a coin toss chance. But there's some services that are so bad, they're very popular too, but they're so bad they're not even right 20% of the time. Okay? But what do these guys do? They tend to love stuff at the absolute riskiest point. The riskiest point on a chart is not at a low. The riskiest point on a chart is at a high. So a stock carries way more risk. Okay, CommScope. Let's just focus on this. CommScope was way more risky at 42 than it is at 17. Now somebody could say, well, wait, percentage chance of, or a percent decline is a percent decline. And if CommScope goes from 17 to 8, it's still a 50% decline. If you had a stop, if you bought it at 40 and had a stop at 37, well, you're only going to take a 10% decline. Well, that only works if you don't get stuck in a gap down, which they had, right? But the whole point is the lower, especially a quality company, the lower the price of the stock is, the risk has been largely wrung out of it. Again, if you don't agree with me on that, I'm sorry, that's not really debatable. So NVIDIA was much more risky at $300 than it was today at $150 or $145. By the way, it still could be pretty risky, $145, but it's a lot less risky at $150 than it is at $300 because guess what? It's just taking a 50% haircut. So the risk of taking that first 50% haircut is gone. So again, this is pretty much undeniable market math. Same thing with the indices. If you're somebody who tends to buy index trades after market corrections, you're letting other people take a lot of the risk away for you. The selling that happens reduces risk. Does it take market risk away? No, not at all. Stocks are always risky. Markets are always highly volatile and highly risky. But the lower the price you can buy, at least you've wrung out especially a lot of long-term risk. You still might have a fair amount of short-term risk because there's always day-to-day price risk and things like that. But I don't know. It's worked again. Worked for a lot of value buyers over time. I'm not the only one. And again, I'm not saying something that I've created. I'm basically paraphrasing the great ideas of quite a few other people. But again, that's undeniable market math. The lower the price you can buy of a quality company. Now, again, where I would say that this method might not hold, this is why I mentioned quality companies. Is there just as much risk of a penny stock after it's 1 as there was at 4? Probably. I mean, in other words, if the stock has a high risk of just not being around, then at any price that could go to 0, yeah, there's roughly an equal amount of risk, right? If you have a high risk of insolvency, then the decline in price doesn't matter that much. But I don't really deal in hardly any companies that have much of a risk of going bankrupt or becoming insolvent. So for me, the higher the quality company, the lower the price you buy it, you've already wrung out a lot of risk, especially if you hold it for a while. Anyway, that's I wanted to clarify that.
All right. Well, I think that covers a lot of ground for us today. You got some interesting index sentiment out there, how you've kind of changed your overall projection, indicated some new ideas, some of your favorites, and really laid out some of your philosophy as far as your trading/investing style. So I think that covers a lot of ground, a lot to chew on, and I think the listeners will be able to get some good educational information from this when the markets are slow as this day, or excuse me, as the week progresses. We might not have a
Well, by
lot
the way,
to
this
do.
was supposed to be a slow week. This was supposed to be kind of a unexciting week. This has been a very exciting week.
Yeah, the first couple days usually are, and then tomorrow, and then although I do seem to remember several years back. It might have been, 10 years back maybe, where I think it was over the Thanksgiving holiday, and we had that Greek debt crisis, and markets were just all over the place. Silver was going nuts, and all kinds of just crazy future markets were just going pretty crazy. That was when the Greek debt crisis first, it was like the tip of the iceberg before it really got going, and I believe it was over a Thanksgiving holiday.
It kind of remember. I almost wonder though if it was kind of the same. I mean, here's the other thing to remember too is that you gotta separate your sell-offs, and by that I mean, this is a very low liquidity week. Mm-hmm. A lot of basically buy side volume was already going to be super skinny to begin with. Again, sometimes stocks go down a lot just because they can. Because they're easier to attack, they're easier to algorithmically engineer lower. And again, I'm not saying that this is a minor part of my call, by the way, but I kind of been waiting for something like this. I kind of call this a trap, basically like almost like a bearish trap. Same thing that happens at highs. You suck in the longs, you have a big flourish. It's like, oh my God, there's just no way these stocks can't just keep going higher, and there's a trap door, right? Same thing happens at lows, and especially we have seen this in recent years. A lot of lows tend to be set not during necessarily periods where we have news or something bad happens or like a catalyst that makes stocks go lower. It just is a period of low liquidity. And so what happens is, to the degree there's any sell-side volume at all, it gets massively magnified because it's basically a buyer strike. There's no buy-side liquidity, and it's just easier to push stocks lower. And I think we might be seeing a little bit of that this week. Because, I mean, I don't know. Was the news any different when we got up Monday morning? For the last 2 days, has the news been materially different than it was the middle part of last week? I don't think so. The only major difference in market structure this week is that there's tons of people on vacation. There's not very much buying interest out there. So therefore, got to know that. Got to know that, that the people that want stocks lower are going to have an easier time pushing stocks lower. So, you kind of got to just be more aware of I think liquidity conditions now, probably more than ever, especially if you're short-term trading. I don't worry about it as much unless I want to put my buying hat on. But I think that's something that, I don't know, I've kind of been looking for one of these like low liquidity, sort of sharp sell-offs. That's kind of a necessary precursor anymore. It wasn't the case 5, 10, 15 years ago, but certainly been the case since, 2014. Pretty much since 2014 on, a lot of these sell-offs tend to kind of culminate during a period of low liquidity. And this week would definitely meet that sort of necessary ingredient. But yeah, we'll see what happens. Like I say, I think, and read that note. I mean, I didn't say that this is going to be easy. I was pretty clear in saying that I still think there's going to be a lot of chop. I plan on increasing my short-term trading frequency. I'll probably post more short-term trades. But again, even my short-term trades are not probably, I don't know if they're ever going to be intraday. They're probably going to be at least multi-day to maybe 1 to 2 weeks. Probably be the shortest trades, my short-term trades that I probably ever post on the briefing platform. So the bottom line is, I still think there's going to be a lot of chop. There could be a pretty strong tax loss selling bias into year end. But again, I don't know. We'll see. I mean, we'll see. The fact that nobody believes we might have a year end rally, maybe we'll have one. But I just want to close on the fact that, like I said, just because I'm saying next major move is up, doesn't mean it's going to be easy. It doesn't mean it's going to be smooth. If anything, you tend to get the biggest gains during periods where there's a lot of up and down chop, and you get this kind of this violent sawtooth pattern higher, and that's kind of the pattern I see playing out over the next few months.
All right. Well, why don't we leave it on that note? And I think, like I said, there's a lot of good stuff in this one. So if you have nothing to do, let's see, want to get away from the family and get some information, well, this would be a good one to re-listen to. Anyway, all right, Sean. Well, why don't we leave it on that note and have a happy Thanksgiving.
You too.
All right. Thanks again.
Take care.
All right.